Welcome to the video. Today we'll uncover how advisory fees can silently erode your retirement nest egg and what to do instead. First, we'll set the stage with the scale of the problem. Then, we will compare advisor types, fees, and evidence-based alternatives. Finally, we'll walk through a practical do-it-yourself plan and when it still makes sense to hire help. Let's begin. Here's our agenda for today. First, the problem, how fees compound against sustainable withdrawals. Next, the difference between a fiduciary advisor and a salesperson. Then, we'll compare fee-only pricing with asset under management fees. After that, we'll cover evidence supporting low-cost indexing. We will then build a DIY plan and a fixed income ladder. Finally, we'll discuss when an advisor is worth it, summarize key takeaways, and end with a brief disclaimer. Let's move on to the problem section. The core issue is that a 1.25% annual advisory fee is not small when compared with a 4% withdrawal rule. To maintain your intended spending, the portfolio must first earn enough to pay the advisor and only then fund your withdrawals. Over decades, this drag compounds and can easily run into 5- or 6-figure sums. With that context, let's visualize how the math flows in practice. This flowchart shows how returns are split. First, gross portfolio return must cover advisory fees. Next, only the remaining net can support planned withdrawals. Both the fee and the withdrawal reduce the future balance, which increases the risk of shortfall. In formula terms, the required gross return approximately equals your planned withdrawal rate plus the advisory fee plus fund expenses. For example, with a 4% withdrawal, a 1.25% fee, and 10 basis points of fund costs, you need around 5.35% just to maintain purchasing power. That means almost a third of your planned income is effectively consumed by the fee. Now, to quantify how this looks across portfolio sizes, let's compare costs. This table compares the annual cost of a 1.25% asset under management fee versus a low-cost investment approach at roughly 10 basis points. It also shows the annual difference and a simple 20-year nominal difference without compounding. The point is not that these exact numbers will be your experience, but that the order of magnitude is substantial. Next, let's clarify advisor types and why fiduciary status matters. On the left, a fiduciary has a legal obligation to act in your best interest. They disclose conflicts and costs clearly, often recommend low-cost strategies, and should be willing to sign a written fiduciary commitment. On the right, a non-fiduciary operates under a suitability standard. They may sell products with embedded commissions, tend to use higher fee structures, and may avoid signing a fiduciary oath. With that distinction clear, we can now examine how advisors charge fee-only versus assets under management. This sequence diagram contrasts cash flows. With a fee-only planner, you pay a flat or hourly fee for a plan. You then implement it at a discount broker with minimal ongoing costs. In contrast, an AUM model charges an annual percentage of your assets, which increases as your portfolio grows. Because investment management is often standardized, paying a large percentage fee can be hard to justify. Next, let's look at the evidence for index funds over active management. This pie chart summarizes the long-run result. The majority of active managers underperform their benchmark after fees and taxes. The primary drivers are higher costs, frequent trading, and tax inefficiency. Therefore, a globally diversified portfolio of low-cost index funds is statistically favored. If the investment chassis is set, let's outline a practical do-it-yourself plan. Here is a practical sequence to build your retirement plan. First, define your goals, timeline, and emergency reserves. Next, inventory every account so you know where assets live. Then, select low-cost index funds to cover domestic stocks, international stocks, and bonds. After that, determine an allocation that matches your risk capacity rather than making market predictions. Build a 3- to 5-year fixed income ladder for spending stability. Automate contributions, rebalancing using tolerance bands, and tax-efficient asset location. Clearly document your withdrawal rules and which accounts to tap first for tax efficiency. Finally, review annually and only revise when your life plan changes. To make the timeline concrete, let's visualize it. This timeline walks through a 90-day plan. Weeks 1 and 2 focus on defining goals and compiling account inventories. Weeks 3 and 4 establish the low-cost fund lineup and a target allocation. Weeks 5 and 6, ensure accounts are opened at a discount broker. Weeks 7 and 8, consolidate and simplify positions into core index funds. Weeks 9 and 10, construct a 3 to 5 year treasury or CD ladder for spending needs. Weeks 11 and 12, automate contributions, set rebalancing bands, and arrange tax-efficient asset location. Week 13 finalizes a written withdrawal policy and an investment policy statement. Thereafter, you maintain quarterly check-ins and an annual deep review. Next, we will illustrate the ladder itself. This Gantt chart represents a 5-year ladder. Each bar is a rung, 1 through 5 years to maturity. The strategy is to cover several years of withdrawals with safe instruments. As the shortest rung matures, you spend from it and optionally roll a new 5-year rung to maintain the ladder. Buying treasuries or insured certificates of deposit through a discount broker keeps transaction and ongoing costs minimal. Now let's test your understanding with a quick quiz. Question: if you plan to withdraw 4% annually and pay a 1.25% asset under management fee, plus about 10 basis points in fund costs, what gross return do you need just to maintain purchasing power? Options are A, about 4%, B, about 4.25%, C, about 5.35%, and D, about 6.5%. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is option C, about 5.35%, that is 4% withdrawal, plus 1.25% advisory fee, plus 10 basis points of fund expenses. Question: which arrangement best ensures your advisor must put your interests first? Options are A, commission-based representative, B, non-fiduciary AUM advisor, C, fiduciary fee-only advisor, and D, any advisor with a nice website. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is option C, a fiduciary fee-only advisor. A fiduciary standard creates a legal obligation to act in your best interest, and fee-only compensation reduces conflicts of interest compared to commissions or percentage of assets. Advisors can be worth hiring when they address complex estate, tax, or business planning needs, provide behavioral coaching that prevents large errors, complete one-time projects such as a withdrawal policy, or manage specialized issues like pensions, stock options, or cross-border considerations. However, the value delivered should clearly exceed what you would pay in an ongoing 1.25% fee. Now let's consolidate the critical action items. Here are the core actions. Request a signed fiduciary commitment. Select fee-only pricing and avoid percentage-based management for generic services. Rely on low-cost index funds with automation. Build a 3 to 5 year fixed income ladder to stabilize withdrawals. And review the plan annually with changes only when your life circumstances change. Before we wrap up, a brief but important disclaimer. This content is for educational purposes only and does not constitute financial, tax, or legal advice. Everyone's situation is different. Consider consulting a fiduciary, fee-only professional who can evaluate your specific needs and circumstances. With that noted, let's summarize the main points. In summary, a 1.25% fee is a large headwind against a 4% withdrawal strategy. Prefer fiduciary, fee-only arrangements, and avoid sales-driven incentives. Evidence strongly supports low-cost indexing over most active management. Stabilize your retirement income with a 3 to 5 year ladder. Finally, pay for specialized advice only when its value clearly exceeds its cost. As we close, here's a creative ask to help this channel grow. Thank you for watching. If this video helped you quantify fees and keep more of your returns, please like the video, share it with someone nearing retirement, and subscribe for more evidence-based strategies. In the comments, share your action plan or questions so we can tackle them in future episodes.